Do you ever wonder where in the heck these millionaires and billionaires keep their cash when the FDIC insurance is only up to $250,000 per person? What if I told you that you don't have to be a millionaire or billionaire to find different ways to save your cash for the down payment of your first home, your first investment property, home improvement projects like getting a brand new kitchen, or a sizable emergency fund because you're getting ready to retire? So in this video, I'm going to talk about the different types of accounts where high net worth individuals store their cash, like money market accounts, cash management accounts, and brokerage accounts. Still, you don't have to be a millionaire or billionaire to open those accounts. Some of you may say that cash is trash. Well, I would argue with you, sir or ma'am, that having liquidity is very important because having that cash cushion will prevent you from getting into debt or taking money out of your investment account. In other words, you do not want all of your assets tied up in your retirement, real estate, or taxable brokerage accounts. I always say that cash is like the mattress between you and the floor. Would you rather sleep on the floor every night or sleep on the mattress with a comfortable cushion? So let me first get into how millionaires and billionaires manage their cash. According to CNBC's Millionaires survey in 2023, about 24% of millionaires were keeping a significant portion of their wealth in cash. It doesn't mean that they're leaving all of their cash in a checking account, earning them 0.02% in interest. The vast majority of their assets are still in their investment accounts. They also understand that cash will lose value over time, so they have to put their cash to work in some way. They recognize the importance of having liquidity so that when they have unexpected expenses, they don't need to sell off investments, borrow money, or pay a penalty for taking out their retirement early. But there's a term that distinguishes millionaires from net worth millionaires, and that's called a high net worth individual, or HNWI designation. A high net worth individual is someone with at least $1 million in liquid assets, which means that person has a combination of bank accounts, stocks, bonds, and cash totaling at least $1 million. Your real estate portfolio, business portfolio, or the equity in your primary home does not count because those are considered illiquid assets. And if you have at least $30 million in liquid assets, then you are designated as an ultra high net worth individual. And as of 2021, there are more than 520,000 ultra high net worth individuals in the world, and a third of those individuals reside in the US. And the person identified with a high net worth or ultra high net worth individual designation can go to banks like JP Morgan or Morgan Stanley to open private wealth management accounts so that they have access to investing in hedge funds and private equities, or even act as angel investors for startup companies. A high net worth individual can also qualify for status, also known as accredited investor. And the SEC dictates that an accredited investor must have a net worth of $1 million or more, not counting their primary residence, and an individual income of at least $200,000 a year or $300,000 with a spouse. But this is a topic for another day, so be sure to subscribe if you haven't done that already. And high net worth individuals with sizable cash assets usually go to a dedicated banker who provides a cash management account with higher FDIC insurance coverage limits. I'm going to explain how that works later on in this video. But whether you're a high net worth individual or someone working to become one, there's actually no limit on how much you can put in a checking or savings account. Most people just don't want to exceed the FDIC limit in case the bank fails. And we saw several banks fail in 2021, 22, and 23. But high net worth individuals choose banks that are typically what we call too big to fail. So what are some of the banks that may be too big to fail? JP Morgan Private Bank, Citi Private Bank, and Bank of America Private Bank are actually some of the most popular banks for millionaires to keep their cash in their checking accounts, because if they fail, then there's something bigger happening in the country for a bank like JP Morgan to fail, right? But the question will come down to whether I really need to put more than $250,000 in cash in a checking account. And I never put more than I need for the year because a checking account is used for daily expenses. Would someone need to have that much cash in a checking account for regular expenses? Probably not for the average American. But large liquidity is necessary if you're running a business or own multiple real estate properties. So if my fireside chat business spends $300,000 in annual operating expenses, having that much cash in my business checking account wouldn't bother me. And anything in excess should be invested to make that money work for me. So you have to be very intentional with what you're spending, even for a millionaire or billionaire. And I also run my own private client program to help people manage their cash. So if you're interested in becoming one to work on your financial independence journey, you can schedule a 60-minute consultation with me by visiting firechat.com/consultation. So where do millionaires and billionaires keep their money? Again, most of their money is tied up in stocks with a brokerage account that will have a higher return than keeping cash in a checking account. But anything cash or cash equivalent assets can be in the following accounts. For their daily expenses, their cash will be in a private wealth checking account with the most trusted bank that is too big to fail, like I talked about in the previous segment of this video. They will also have several high-yield savings accounts across different banks if they need cash more than the FDIC coverage limit. Remember, the FDIC limit is per individual per bank, so you could have $250,000 in cash with one bank and another $250,000 in cash with another bank, and you're still going to be under the FDIC limits. They can also have what's called a cash management account, or CMA, and it's pretty popular among high net worth individuals because a CMA comes with a debit card and ATM access, and it extends FDIC coverage limits by putting additional deposits into partner banks. And keep in mind that a CMA acts as a brokerage account and not a bank account. It's like a facilitator between investment and cash accounts. It comes with a debit card, personal checks, and bill pay, just like a regular checking account, but with some options. Allow me to explain how it works. For example, when you open a CMA, you can generally choose two options. The first option is putting your cash in a money market fund with a high yield return. And at the time I'm recording this video, you can find a government money market fund that pays about 4.3 to 4.5% in a 7-day average yield. But remember that the money market mutual funds are not eligible for FDIC insurance, but are eligible for SIPC coverage. So the SIPC protects customers' cash and securities up to $500,000 if their brokerage firm fails. The second option is to put your sizable cash in what's called a deposit sweep program if you need a higher limit on the FDIC insurance. So the deposits you sweep into your cash into this program will spread your money around to several different banks that are participating in this program on your behalf. At a minimum, there are 20 banks available to accept these cash deposits for up to $5 million of FDIC insurance. If you're married, then that's $10 million of FDIC coverage over 20 participating banks. So if you need more than $250,000 in FDIC coverage, you can choose this option to spread the money around for you so that you're not limited to the $250,000 limit. The only downside is that the APY for this account generally pays less than the money market fund. You can, however, open multiple accounts with different brokers to meet your needs. And you can always open a self-directed brokerage account to put your cash in a money market fund, also known as a money market mutual fund. And this is more common for people who want to keep their cash in a safe place. A money market fund invests in securities like bankers' acceptances, certificates of deposits, commercial papers, short-term government securities, and U.S. treasuries. You can also purchase brokered certificates of deposits or brokered CDs inside your self-directed brokerage account. And the difference between bank CDs and broker CDs is that you hold your money inside the bank CDs until maturity, and you'd be charged the penalty if you took it out early. The broker CDs are sold on a secondary market before maturity. So you can sell before maturity, but you're still subject to the market value of the CD. And that market value fluctuates based on the rise and fall of the interest rates. And the other option is to put money in corporate bonds. And please keep in mind that none of this should be considered in any form of financial advice. This is just for educational purposes only. So let me show you how this works. But before I get into that, with the Federal Reserve continuing to cut interest rates in the future, did you know that there's another way to lock into a high rate for the next several years? With a bond account from public.com, you can lock in a 7% or higher yield even when the Fed cuts rates down the road. When you put money in a public bond account, that money will be invested across 10 investment grade and high yield corporate bonds, so you're not putting all your eggs in one basket. With a minimum initial deposit of $1,000, you can spread your money across different industries, maturities, and credit ratings. You'll receive regular interest payments throughout the year from your diversified portfolio of 10 corporate bonds. At the same time, bonds on other platforms are only available in investment sizes of $10,000 or more. So if you're looking to diversify your portfolio and lock in a 7% or higher yield for the next several years with a bond account, you can open an account today at public.com/SI, and I'll put the link in the description below. Thank you, public.com, for sponsoring this video. When you buy a corporate bond, you essentially become a lender to that company, and that bond becomes an IOU. So the company promises you to pay the money back that you loan with the interest. Companies do this all the time to raise capital and operating cash to build their companies. So the typical face value of the corporate bond is $1,000, and that's how much you lend the company, and that's $1,000. The company says that they will pay you 6% in interest for lending them $1,000, which will pay you $60 in interest in 1 year. Remember, when the face value goes down, the yield goes up. And when the face value goes up, the yield goes down. So if the face value goes down to, let's say, $980, but they're still paying you $60 in interest for the year, then the yield goes back up to 6.12%. When the face value goes up to $1,020, let's say, then the yield goes down to 5.89%. That makes sense so far, right? And corporate bonds are rated by agencies like Moody's Investor Service and Standard & Poor's Corporation. If the bonds are rated Baa3 or above based on Moody's rating scale, then they are generally considered to be investment grade. Anything below is generally considered to be below investment grade. And if the bonds are rated BBB or above under the S&P rating scale, they are generally considered to be investment grade, while anything rated at BBs or below is considered to be below investment grade. So make sure to understand the risks versus rewards when you choose corporate bonds. Can a company default on the debt and stop paying you interest? Absolutely. That's the type of risk you're going to have to understand. You can always choose a basket of investment grade bonds instead of individually, as I talked about earlier with public.com. So where do you begin as someone who is actively working to become a high net worth individual? I started with just $300 in my checking account in 2013. And this is how you can begin, like I did over a decade ago. You should always have 1 month of expenses in your checking account. How much does it cost to pay your rent or mortgage every month? How much on average do you pay for utilities, internet, cell phones, gas, and groceries in 1 month? If all of that is going to be, let's say, $3,000, then you should have at least $3,000 carried over month in your checking account. If you're not a high net worth individual, you should stick to a checking account that has excellent customer service and comes with no minimum fees. A lot of big banks will charge you a monthly fee if you don't have a minimum balance or monthly deposits coming into your account. The next thing you need to do is open a high yield savings account designated as an emergency fund. I already put 1 month of expenses in my checking account, so I'll always have 5 months of expenses in my emergency fund. This account is designated for anything unexpected and necessary. A blown tire is something unexpected and necessary, but going to a concert is not something unexpected and necessary, right? The next savings account you should own is an annual expenses account for anything expected and necessary. This is probably the most overlooked savings account that you'll need for annual credit card fees, vehicle maintenance, annual subscriptions, insurance fees, and anything else that's considered expected and necessary. I don't know about you, but I really hate it when I forget to budget for a large expense. So for example, if you know that you're going to have to spend $500 on your vehicle maintenance a year from today, then that's an expected and necessary expense, right? So instead of waiting until it happens, start putting away $10 every week or $20 every 2 weeks so that by the time you have to do some major maintenance on your vehicle, you can take $500 out of your annual expenses fund to pay for it. So what I do is just compile all of my necessary and expected large expenses for the year and divide it by 26 paychecks. So if I need to set aside $3,000 next year in my annual expenses account, then I'm going to divide $3,000 by 26 paychecks. Then that's going to be about $116 every 2 weeks I need to put away to this account to make sure I have enough to pay for large and expected expenses. I just automate my savings every 2 weeks. The next savings account you should own is a discretionary account for anything expected but unnecessary. What is considered expected and unnecessary? It'll be your concerts, vacations, sporting events, birthdays, and anniversaries. I wouldn't open this account though until your high interest debt is completely paid off. You can open more savings accounts with a purpose, like a travel fund or a sinking fund for the down payment of your next home. Do you need this many savings accounts? At the bare minimum, you should have an emergency fund in a completely separate savings account, and you should have an annual expenses fund in a separate savings account. When you're debt free, get more savings accounts for your entertainment and travel. And no matter your net worth, your cash management has to come before investments. You don't want to tie up all of your assets in your retirement accounts. You also don't want to have all of your assets invested in stocks or real estate. You need to have cash savings accounts that can pay you enough interest to beat inflation every year. The biggest mistake people make is not having enough liquidity, and they end up getting back into debt. Millionaires and billionaires do not carry a balance on their credit cards or take out a 401k loan or a personal loan. They don't over leverage themselves with debt. But if you want to learn more about how wealthy people use the buy, borrow, die strategy to carefully leverage their investments to lower their taxes, you should check out this video next. And this has been another beast of a video, and I hope we got a lot out of it.